Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Intelligence with Scarlet and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlet and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, as earnings season rolls on, we'll take a look at results from some of the biggest names in food, travel, and entertainment.
Plus, the cash stockpile at Berkshire Hathaway grows to a record.
But first, this week, Yum! Brands launched a strategic review for the pizza maker Pizza Hut. This comes after the company reported earnings that beat Wall Street estimates. For more, we were joined by Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst. We first asked Michael for his take on the possible sale of Pizza Hut.
I think this was kind of a long time coming. It's really been a drag on the top and bottom line growth. Taco Bell is an absolute monster, is putting up strong unit growth as well as same-store sales growth quarter after quarter after quarter. KFC has had some well-documented same-store sales issues in the U.S., but that seems to be turning. They had a solid little quarter here with flat same-store sales versus 6 straight quarters of decline. So that business seems to be accelerating a little bit. And KFC unit growth overseas is phenomenal. Absolutely phenomenal. They crush it overseas. Yeah. So Pizza Hut has been this drag on this business for quite some time. I think the street is really excited about a potential divestiture here.
Any potential buyers out there that you can identify?
No, we don't have. We don't think any of the companies in the public market are going to be an acquirer of Pizza Hut. Yeah, this thing is, like I said, it has struggled mightily. I mean, we could see private equity. I think private equity would be a good fit, right? Because it's going to take, management said on the call, it might take some of their markets 2-3 years to get them back to like their rightful position as market leader in those countries, which they see as their rightful, position. I think Domino's would have something to say about that. But, it's going to take a few years to turn around some of these markets, and private equity, obviously, looking at a 5 to 7 year time horizon would be a good fit.
All right, Mike, let's step back. The restaurant space in general, getting through, earnings season here. What are you learning about kind of the consumer out there from the restaurant perspective?
We heard from Wingstop and another fast casual chain that's struggling, also partly been a victim of its own success, right? It's absolutely crushed it over the last 6 years and is lapping very, very strong results from last year. But they talked some more about low-income consumers and Hispanic consumer weakness and it broadening here in the third quarter. There's some optimism here, I think, around the smart kitchens. So
what's a smart kitchen?
They're rolling out some kitchen technology that's boosting operations. It's speeding up service times. They're putting out consistent 10-minute service times, which is 50% better than they were doing prior. Accuracy is better. Food's getting to customers hotter and fresher, and people are going to have a better experience. And so stores that have had this technology, right now it's in about 2/3 of the U.S. stores. It's going to be in all 3,000 by the end of the year. But stores that have this equipment and have had it the longest are outperforming on same-store sales by 500 basis points.
Wow.
So we think that's why the stock is up so much. People are now a little bit more confident in a positive 2026, despite the decelerating trends here in the third quarter.
What's going on the labor front for restaurants? I'm thinking quick service restaurants, with the southern border shut off. That was one of the industries that said we may have some labor problems associated with that. Have you heard from your companies about that?
Yeah, our companies just talk about the fact that they use E-Verify and they do everything by the book, which I think is predominantly the case. The impact that you're seeing A, is with more of the independent restaurants.
Okay.
But then B, also kind of causes labor costs to go higher here for the public chains, right?
Right.
And they're seeing another 4 to 5%, wage rate inflation this year. That's been pretty common year in and year out since the pandemic.
Our thanks to Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Service Analyst.
We move now to earnings from the fast food giant McDonald's. The company reported faster than expected U.S. sales growth in the third quarter. And this comes as the restaurant looks to restore its reputation for affordable meals with new deals and promotions. We are joined by Red Brown, Bloomberg News Earnings Reporter.
I think in the context of the other results that we've gotten from a couple other restaurants, I think it's really interesting. During the call, the McDonald's CEO, CFO really talked about this bifurcation that they've been observing for the last few years between higher income diners and lower income people. And it seems like that trend is continuing, persisting, potentially accelerating. It seems like, and specifically what I'm talking about is the higher income consumers seem to be coming down into McDonald's and shopping a bit more, drawn in by the value that McDonald's has been pushing over the last couple of quarters. And we're seeing that across all of the fast food chains. That's Yum as well, and also Burger King, things like that. And then on the other side of that, companies like Chipotle and Cava, these kind of like middle tier that, $20 bowls of food are struggling a little bit more as like people lose interest in that value proposition that they're offering. So I think McDonald's, obviously the biggest name in the space, really kind of hammers that point home for this earnings season. And I think that's kind of the thing, like the main takeaway for me at the moment.
And of course, McDonald's is leaning into this idea that it offers value at a difficult time for a lot of consumers. It's got a lot of deals and promotions to maintain that reputation. Does that cost it in any way, or do the same store sales kind of back that up, that this works?
I think it's a little early before they've seen that benefit from it quite yet. Like they all have seen a little bit of pressure on the profitability because the company is so committed to this, like restoring the value reputation is kind of the language that they use with their customers, that they're actually supporting the franchisees. They're giving them marketing. They're helping them make up some of that losses that they will make. They will have from offering these discounts on the menu. So McDonald's is committed to this. It sounds like they're committed to this in the long term because they do want to get people back in the stores. It's kind of remains to be seen whether or not the foot traffic is actually benefiting such that it is driving the bottom line as well. But they see it as so important to kind of refreshing or kind of reintroducing the brand proposition to people that they're willing to commit to this, take a little bit of that short-term pain for the long-term benefits.
What are they saying about their cost structure here? I see beef prices much higher over the last year or two. What are they saying about some of their cost of goods sold here?
Well, the one thing to call on the cost of goods sold before we get into the beef issue is the marketing. So they are kind of bumping up the marketing. They saw around a 20% jump in their SG&A expense because of that. But on the beef thing, McDonald's is the largest buyer of beef.
Yep.
So that scale kind of allows them to take it. They can take advantage of the scale and negotiate strong contracts when it comes to beef. Obviously, beef inflation has been hitting all of these companies, but not in a way that the companies are like outsizedly negatively impacted thus far. But definitely something to watch as the beef prices continue to go higher.
And the improvement here, especially for its U.S. comparable sales, really comes at a timely point because for a while, the company had been a laggard when it came to comparable sales, at least domestically.
Yeah, definitely. And it does speak to the kind of strategic changes that they've made. Like they did act maybe a little bit late in the game. Burger King has been rolling out their value offerings for a little over a year. But McDonald's has acted swiftly. It's a big deal, I think, to get the buy-in from the franchisees of McDonald's. Like they had almost a consensus. It's very rare that you see almost like a high 90% of franchisees willing to take the price hits because they're the ones that are dealing with this at the end of the day. But I think McDonald's acting fast, acting boldly to kind of get back into the green.
I've noticed really in the last several years, so much more technology in the stores. Like a lot of them don't even have people practically taking your order. It's all done electronically. What are they saying about their investments in technology, maybe even AI. How's that impacting that business?
Yeah, for McDonald's, there's quite a bit of talk about their digital offerings for this quarter. All of these companies, so between McDonald's, Yum, which has KFC, Taco Bell, and a couple other brands under that umbrella, are all really pushing the digital for that exact reason, to get the costs down. Yep. McDonald's just rolled out their Monopoly program, and when I was a kid, Monopoly was the peel off on the cups. It was very exciting. Now it's completely digital, right? So that's another way of they're trying to drive people into the app to get people to shop through theirs. It's where a lot of promotions are. That'll help also drive foot traffic. So it's helping in two ways. It's helping people get in, shop more, and also helping on the cost front.
Our thanks to Red Brown. He is a Bloomberg News Earnings Reporter.
Moving next to the hospitality industry. This week, cruise company Norwegian Cruise Line reported earnings that missed expectations. For more on this, we were joined by Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst.
People are still cruising. The bookings are higher. I think that there was a bit of a change in their strategy related to the Norwegian Cruise Line brand, trying to get more families and kids and all that. We could talk about that, but that does have some slightly dampening impact on yield growth for the fourth quarter.
So this is the idea that they're broadening their customer base, not just targeting the super high income consumer, which by all accounts is doing just fine in this economy, whereas the lower income consumer and the mass consumer perhaps is struggling with rates staying fairly elevated and a lot of question marks over their job prospects. What is Norwegian Cruise Line's strategy here, certainly compared to its peers like Carnival and Royal Caribbean?
I think it's twofold. I think number one, to try to attract more of a family audience, increase the core customer base of the Norwegian Cruise Line brand, and also by having more shorter duration cruises, maybe with home ports closer to where people live, that could result longer term in kind of more efficient operations and some more more savings on the net cruise cost per net unit cost side. But it remains to be seen, and I think that's why there's a little bit of caution, because the near-term effect will be a slightly dampening impact on the overall mix of yields. Cabins filled with children or families may have a slightly lower combined revenue yield than a different type of customer audience.
Typically, the cruiser, they're pretty loyal people, Brian. How do they typically react, or how do they spend during what could be maybe a little bit softer economic environment?
So if you judge by the current environment, the overall bookings pace, I think for the third quarter overall was up 20%. The outlook for next year is quite good, with at least modest yield growth. So I think we're seeing still a pretty steady pace of consumer demand. Obviously, that could always change if we see a more severe economic downturn, but the overall pace in terms of bookings demand, notwithstanding this kind of tweak in marketing strategy, has been quite good.
Our thanks to Brian Egger, Bloomberg Intelligence Senior Gaming and Lodging Analyst.
Coming up, inside one of the biggest deals of the week, Kimberly Clark buying Kenvue, the maker of Tylenol.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
It was a merger Monday this week in the consumer goods space. Kimberly Clark announced plans to buy Kenvue, the maker of Tylenol, in a $40 billion cash and stock deal.
The combination would create a company with $32 billion in revenue and become the second biggest seller of health and wellness products. For more, we are joined by Diana Gomes, Bloomberg Intelligence Senior Equity Research Analyst.
So it is surprising in many ways from the perspective of Kimberly Clark. I must confess, it shows that Kenvue really has a lot of work to do to turn around the business since it split from J&J about 2 years ago, and the third quarter miss just added up to a pile of disappointing results. Obviously, there's a ton of low-hanging fruit, let's say, in terms of efficiencies that can be gained, in terms of plugging the great, iconic, well-known, trusted brands from Kenvue into Kenvue's system that is running at a more efficient level at the moment. But it will... there is skepticism there, because we are talking about revenue synergies as well as cost synergies, and this will be quite a complex new company. at the point when Kimberly-Clark was just simplifying, as they are aiming to close the transaction on their international business that includes segments like tissue by mid-2026, and now this merger expected to close around the same time just seems to complicate the picture a little bit.
Oh yeah, that
Besides
does sound
the
complicated.
Tylenol, yes, and we know how Kenvue has been dealing with some crises of in the last month with Tylenol, and then with talc lawsuits outside the U.S. as well.
So I'm glad you went there. The Tylenol situation, the Trump administration has been attacking Tylenol overall. Do you think that's something that might complicate this deal? Could regulators step in and hold things up or raise questions that will just drag things out?
Quite different questions, I would say, but great questions. So in terms of Tylenol, the legal risk is there. Kenvue was already fighting in the courts some lawsuits, but we now have a Texas state lawsuit on top of it. The Kimberly-Clark's price, when we look in terms of, for instance, an EBIT to enterprise value multiple, and I'm taking 2025, that they will report. So that will come at about 14 times, whereas historical transactions in the consumer health space were in the range of 16 to 20 times. So 14 times comes below that. So really reflecting not only the struggles of Kenvue, where their organic growth is still declining, but also that liability risk with lawsuits that are ongoing, and that's new lawsuits that can be added as well. In terms of the, say, antitrust competition, regulatory approval, as I see it, they don't really overlap directly, but it really depends on a country, region by region basis, because we know the US stance can be very different from the European Commission one.
Diana, should we expect more consolidation in the consumer product space, do you think?
Yes, so that's a theme that I've been watching very closely. Obviously, we had other large pharma groups with significant consumer health businesses. So we are talking not only over-the-counter medicines, but also the more personal care that deals with wellness. Sanofi decided to sell it to private equity. So at least for the next few years, that is that. Bayer is still considering, well, not considering, as management puts it, but Bayer still has their consumer health business, and they could be looking into either listing it or further consolidation within the current players.
Our thanks to Diana Gomes, Bloomberg Intelligence Senior Equity Research Analyst.
We also got earnings in the media space as well.
Warner Brothers Discovery, the parent of HBO and CNN, reported third quarter sales that missed analyst estimates, providing a glimpse into the company's businesses as it puts itself up for sale. For details, we caught up with Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
So fundamentals, Scarlet, really don't matter all that much at this point, especially. Yes, the TV networks business, as we know now for many, many quarters, has been severely challenged. We saw a 20% slump in TV advertising. We saw a 20% decline in TV EBITDA. This was kind of well expected. And this really speaks to why they need to separate themselves, why they need to separate the low growth, or rather the no growth TV assets from from the part of the business that's actually growing, which is studio and streaming. That part of the business actually posted really good numbers. We saw the studio. Warner Brothers has actually been having a very, very successful run at the box office this year. They have about a 27% share of domestic box office, and we've seen that kind of translate into really strong EBITDA numbers. And so we saw studio and streaming actually put up really, really good numbers. And that again speaks to why so many different parties, including a Netflix, including a Comcast, are interested in going after those studio and streaming assets. So right now, again, fundamentals don't matter that much. It's really all about the M&A.
And I'm actually surprised, Geetha, that maybe we haven't had some more news on the M&A front, because we've seen, the M&A environment is very, very active. The market's very receptive to M&A here. We have a willing seller in terms of David Zaslav and the board of directors here. How do you think this is going to play out? Is somebody going to make a bid for the entire company, or just maybe the good pieces for it?
We're having all possible permutations and combinations here, Paul. So we know that Paramount Skydance is actually interested in all of the company, including the TV networks. They've already made 3 bids. The highest one was for $23.50 per share for Warner Brothers Discovery, all of it. That was turned down. So they obviously have to come up with a much better offer. Now, the other bidders, and the 2 that are most often mentioned, are Netflix and Comcast. They are the ones that are only interested in the studio and streaming assets, no interest at all in the TV linear network business. We know that Netflix has started looking into the books of Warner Brothers Discovery. This doesn't necessarily mean that they have to come out with a bid. I mean, remember this, Zaslav is, as you just mentioned, he's a very, very tough negotiator. He's a deal maker. He is going to make sure that they really get paid well for the streaming and studio assets if they sell that. And we expect, a price tag somewhere in the ballpark of about 75 to 80 billion. So, whoever makes a big bid has to cough up a huge chunk of change for this asset.
So we keep talking about how it's Netflix, Comcast, and Paramount Skydance. Could there be another bidder that emerges from the shadows?
Absolutely. I mean, you can never rule out big tech. Amazon obviously has shown some interest in the past. They bought the MGM studio. We're not necessarily sure whether they've actually taken a look at the Warner Brother assets. But again, Scarlett, as you kind of think about the whole media landscape and you kind of think about the various assets out there, this is kind of a once in a lifetime, kind of a generational opportunity for anybody who wants to get big in media to really go after Warner. I mean, they have some of the best IP out there. They have a streaming business that has performed really well. HBO Max is a name that resonates across the globe. So anybody and everybody should really be taking a look at this asset. So I wouldn't be surprised if we have some kind of a dark horse bidder here.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst.
We also got earnings reports this week from 2 of the world's biggest rideshare companies, Uber and Lyft.
Mandeep Singh joins us here, research head of Bloomberg Intelligence on tech stories. Talk to us about that segment of the economy, the ride sharing, the outsourcing, the third party delivery. Are people still spending money on that stuff?
They are, and all these companies, I mean, Uber reported over 20% growth, DoorDash reported 25% top line growth. Even though the stock reaction was negative, that was primarily because they plan to spend more money next year on building their tech stack. I think what the playbook here is to expand in more geographies as well as branch out into other areas of last mile delivery. And in the case of DoorDash, they're experimenting with delivering food without a courier, human person involved, and also expanding into restaurant point of sale devices. I mean, they're developing technology where you can pay using a DoorDash hardware and point of sale device. So clearly there is a lot that these companies are doing beyond, the original business that they had.
When you spend time in England and you go pay for a meal, the card never leaves your presence. Mm-hmm. They just tap it on some machine and boom, you're all done. Here, they take it, they put it in a little folder, they take it away for 5 minutes.
And that's what you pay 20% for.
You don't know where it's going. And that's why I'm surprised we're so behind here in the U.S. about that point.
We've always been
payment.
kind of behind, though.
Yes.
That's been our calling card.
The way to think about it is there are so many legacy systems that anytime you have new technology, even everyone is talking about AI agents and whatnot, it has to sit on top of a lot of legacy technology. Yep. And the promise of AI is it can rewrite a lot of that legacy code and migrate into the modern technology, but we have yet to come across real proof points of that.
So when you were talking, Mandeep, I noticed that you talked a lot about how these companies are spending, they're investing, and I'm curious about the reception that gets from investors, because initially in the big AI buildup, everyone was excited about these plans. But now more and more, everyone's like, oh, I'm not so sure that's a great idea that you're spending so much, whether it's on AI or whether it's on new products and internal platform like it is with DoorDash. Why do you think investors are now more skeptical about this idea of companies spending?
Well, just because we've seen, Uber and all these companies really struggle with free cash flow initially. I mean, in the ZERP era, these companies burned a lot of cash. Now they have gotten to a point where the business model does generate, $7 to $8 billion in free cash flow for Uber. And even for DoorDash, it's 20% EBITDA margin. So the fact that they're talking about spending again, it makes you think, okay, if you're an investor, you waited all this while for these companies to get mature and, start delivering on cash. And now they're talking about another investment cycle. And that's where, in the case of Uber, their hand is forced by Waymo launching on 10 cities and really expanding, and potentially Tesla. I think in the case of DoorDash, they feel, making acquisitions will help them expand their geographic footprint. And then obviously they want to expand their tech stack to more areas.
Our thanks to Mandeep Singh, Bloomberg Intelligence Global Tech Research Head.
Coming up, Berkshire's cash pile soared to almost $382 billion. That is a fresh record for Warren Buffett's company. We'll bring you details.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
You can always access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Scarlet Fu and Paul Sweeney on Bloomberg Radio.
Berkshire Hathaway reported its cash pile reached over $381 billion in the third quarter, a record. This comes as Berkshire Hathaway declined to buy back its own shares for the fifth straight quarter.
So we brought in Matthew Palazola, Bloomberg Intelligence Senior Analyst of PNC Insurance. We began by asking Matthew to break down Berkshire's most recent quarter.
The interesting thing is the stock has underperformed the market by like 30% since Buffett announced that he was stepping down in May. And they haven't bought back any stock over that entire period.
Yeah, does that...
I turn my mic on, I say, why?
Yeah. So Buffett used to have a rule when the stock was above 1.2 times price to book, they wouldn't buy it back. They kind of kicked that out and they said, we're just going to buy it back whenever we see intrinsic value below. So, I don't, to me, it begs the question. I mean, maybe he sees the stock as kind of fully valued, even down, year to date. Even
with the lagging performance as well. So does that change when Greg Abel, the handpicked successor to Warren Buffett, takes the reins officially at the end of the year?
Scarlett, he walks a fine line between putting some sort of stamp on the company, maybe over time, and then kind of respecting the ethos of Berkshire and how they've operated. I would hope something happens. I mean, they did a $10 billion deal in the fourth quarter. They bought the OxyChem business from Occidental. They just don't have things that can move the needle very much. Even in the quarter, their net stock buys and sells were a negative $6 billion. So they were negative on other equities as well.
Yeah, they were net seller stocks for a 12th straight quarter, and that cash and equivalents was at a record high at the end of September. Is that a signal that they're waiting for the market to tank, that they see a correction, maybe not tank, that might be too strong. They see a correction or consolidation in the near term and are ready for it?
They're always ready for it. Buffett has always said we're not looking to time the market. We're just looking for good companies. He's also been, when I talk to people, the thought is he just hoarding money for Greg Abel and kind of setting the company up and just handing it over? He's said he's not doing that. So, unfortunately, they don't talk to investors. So we can't really pick his brain besides at the annual meeting. So we don't exactly know what's going on there. I think he's just, extra conservative in his old age, I guess.
All right, here's my cynical Wall Street perspective. When Mr. Buffet passes, 3% dividend yield, massive stock buyback. Do you think that's a scenario?
I think dividend yield, hopefully, some sort of dividend, maybe special dividends. The buyback, I think, will also kind of weigh on what Abel sees the intrinsic value. So I would say probably... hopefully dividend. I would say maybe more steady buyback. There's also, they can't buy back a ton of shares on volume because there's rules on how much they can buy back and how active they can be in the market. So that limits them a little bit.
That's plan B. Don't you have to split the stock like a gajillion to one?
Well, they have the A shares and the B shares, but there's, I don't have all the exact rules, but they've talked about we can only buy back so much at a time. They bought back none. So I think a steady buyback plus some returns of capital in forms of, I would hope special dividends. Maybe they don't want to be beholden to a regular quarterly dividend.
Yeah, makes sense. Okay, so that's something we'll watch for when that eventually happens. In the meantime, how are the businesses of Berkshire Hathaway performing, especially insurance?
Yeah, so all good in the quarter. The insurance business made much more money than the year ago, but that was because they had a bunch of large losses in the year ago. They also had this favorable reserve development, which means they write business and those losses come in better or worse than they expect over time. And those losses were coming in better than they expected. So it's a good thing, but it's not a super high quality source of earnings beat. So the insurance business performed well on those two things, which aren't super high quality in my opinion. The underlying business in the insurance doing well. The problem is it's hard for it to get much better next year. The underwriting side, the prices in that are going down. So I think it's tough to see the insurance underwriting doing better next year. It's also tough to see the investments doing better next year. And we're talking about really just the fixed income investments. So like the equities, who knows what happens. But in terms of the interest income, we saw that decline in the quarter as well.
The business fundamentals of the underlying businesses, did they move the stock historically?
Not really.
No.
Yeah.
So
it's tough.
So Scarlet asked the one fundamental question. That's enough. Let's get back to the main point of the story here.
It's also my job too.
Is there an activist investor who's ever
good question.
mentioned one word about this company?
So historically, there have been investors very vocal about it. I don't have names, but no one's ever been able to move the needle. Buffett's always the majority shareholder, so there's really been no one who's ever been forcing them to do anything. So why would they even listen?
And can you do that with a company that has an A-class share and B-class share?
With this, what is his voting control? I haven't done the math.
I don't know off the top of my head. I thought it was something like 60% of the shares, something like that. And other insiders will hold more. So there's almost no way of wrestling control from him. The A shares and the B shares, they did. So the A shares are several $100,000, and then they instituted the B shares, and they're kind of pegged to each other. So you couldn't buy up the B shares and kind of take control either.
They've come up with all kinds of rules to make sure that all the things you just proposed can't happen.
I know. I'm not the first one.
He's not a dumb guy, Buffett.
Yeah, he knows what he's doing. Exactly right. It's been an extraordinary run. Is there a sense that the law of large numbers over the last several years, if not the last decade, has kind of caught up to this name?
Yeah, for sure. I mean, they bought a company for $12 billion, Allegheny, and it barely moves the needle. They bought this OxyChem for $10 billion, barely moves the needle. They bought like $20 billion of Chevron stock 2 years ago. It didn't even come up at the annual meeting. People didn't even ask about it. I was sitting there. I couldn't believe. I said, no one's going to ask about this. So there's just things that are tough for them to move the needle from having so much money. They're making those investments in Japan, which I think are interesting. So they invest in the trading houses in Japan. It's hard for me to know a ton about those businesses. Some of them are like mini Berkshires. Maybe this is stuff that they kind of do in the future. Also, the energy business. Greg Abel's an energy guy. Aon is an insurance broker. They talked about last week this huge opportunity with the hyperscalers needing risk transfer services and other things. So those are things that fit right into Berkshire's wheelhouse, right? The risk transfer and the energy businesses. So those are opportunities for them in the future.
Our thanks to Matthew Palazola, Bloomberg Intelligence Senior Analyst for PNC Insurance.
We move next to earnings from the entertainment space. This week, Spotify reported active users and sales beat expectations in the third quarter.
But ad-supported revenue declined 6% from a year ago because of pricing pressure. For more, we were joined by Geetha Ranganathan, Bloomberg Intelligence Analyst on U.S. media.
I actually like the Spotify numbers. The big numbers that we always look for are, of course, the user metrics. We want to see them kind of do well on both monthly active users, which are basically the free listeners, as well as the premium subscribers, which is basically, everyone paying about $12 a month for a Spotify subscription. And both those numbers came in well ahead of guidance. The other number that we look for in Spotify results is gross margin. This has been, a constant point of debate, but Spotify has done really well in terms of expanding their gross margin. They again delivered numbers ahead of guidance, both for third quarter as well as ahead of forecast for the fourth quarter in terms of guidance. So fundamentals seem to be really strong. I think the one concern, Paul, that has really kind of of emerged with Spotify over the past few months is pricing power. Are they going to keep, being able to increase prices? And this is something that has dominated the conversation for not just Spotify, but of course, for any streaming company. We've seen Netflix, as you just pointed out, demonstrate really good pricing power. I think Spotify has very good pricing power as well, but people are really waiting for the next big US price hike to really gain more confidence in the story.
Geetha, what's the competitive landscape for Spotify out there? Because as we think about the video business, it's Netflix, and then a kind of a big drop down to Disney, and then a bigger drop to kind of everybody else fighting it out. What's the landscape for in the audio business?
It's actually very similar, Paul. In fact, Spotify just leads by a wide margin. So if you just look at both the global audio streaming market in terms of subscribers, they have about a 33% share globally. They have close to almost a 40% share in the US market. So way ahead of their competitors. So obviously gives them a lot of, I think, again, we come back to pricing power, gives them definitely a lot of pricing power in the market.
So what's on the cost structure for them? What are the real levers for them? It seems like, I know at Netflix, they got to write big checks to, either license content or, create their own content. What's it like on the Spotify side?
Yeah, you bring up an excellent point, Paul. And this has kind of, again, been one of the pain points for Spotify because, again, this is a music streaming service. They don't own any of, the music, music itself. That's all kind of controlled by the labels. And as you well know, content is king. So this is really where Spotify has a lot of trouble because for every dollar that they earn, about 70 cents goes back to the music label. So they have very little leverage. They've been trying to kind of change that whole dynamic, that whole equation, come up with more of their content. So a big investment area for them has been, podcasts, has been audiobooks where they kind of get better, profit dynamics. It has worked well. But actually, one of the things that we're kind of looking for next year is we're going to see a step up in all of the royalty costs. And that's, again, something that the street and investors are a little bit nervous about because we need to see how, Spotify kind of manages their whole margin expansion story as those royalty costs go up. So the amount that they're paying all of the music labels, the Warners and the Universals of the world is going to go up slightly. But we still think that they're in good shape. They've been adding a ton of new features to all of their tiers. They're probably going to debut some new tiers. Again, all of that builds to that whole pricing power and monetization story.
And how is Apple as a competitor here? Because anytime I see a company that's even remotely in competition to Apple, I get nervous.
So Apple, if you're just kind of looking at it in terms of share, they are way below Spotify, both globally as well as in the US market. So not much of a competitor from a share standpoint. In fact, they've even priced their product slightly lower. Some of the noise around Spotify and Apple has been, in terms of the iOS and whether, Spotify can kind of get better terms. And they've managed to do that as well. So some of the changes on the iOS system have actually helped Spotify in terms of getting a better market share and getting better economics, actually. So Apple Music, not too much of a worry for Spotify.
Our thanks to Geetha Ranganathan, Bloomberg Intelligence U.S. media analyst. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries.
And remember, you can always access Bloomberg Intelligence via BI Go on the terminal. I'm Scarlet Fu.
And I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.